So today I'm going to talk about financial risk management. I'm doing this for two reasons. I'm doing this so that you understand a very important element of finance. And as you will see today, it is an element that had a sea change to how finance and mathematics and information management and technology has been developing over time. The change happened gradually over the last 100 years. I'll do that for you. But there's also another reason, which is through financial risk management, we're going to justify why we need to do some of the rather advanced and oftentimes strange things that we'll have to do in the next lectures. I want to do this as motivation for some of the more advanced topics that I will be discussing. I'll talk about Monte Carlo. Why am I talking about Monte Carlo? Well, this is the reason. I need you to understand financial risk management. I'll be doing a fairly robust and mathematical discussion on probability theory and stochastic processes. Why am I doing that? Well, financial risk management is the reason. Financial risk management is the reason for many of those things. There's another reason for those things, which is not the subject of the lecture today, and this is trading strategies that happened in the later part of the 20th century. So I'll be addressing that in a separate lecture. So what we're seeing in the next few days is going to be a combination of things which are important to know from a financial perspective and to understand the financial industry, but also to justify some of the lectures I will be giving you, and frankly, very much of the content which is in the FIM program at KIU. It all arises from this. Now, to understand risk management, I like to talk about the 20th century, and I want to look at the 20th century from a failure perspective. I want to talk about everything that went, not everything, but many of the things that went wrong. I want to go through the highlights of what went wrong, because as you're about to find out, everything that went wrong had a response. And the response was typically a regulation, but a regulation that, especially after computers were introduced, were expressed in technology terms. And data science and probability and mathematics and all of that became part of the law. That's why I'm doing that. Now, not to give you the wrong perspective on this, I have to mention that 100 years is a very short period of time for finance. I think I discussed with you when I talk about the history that futures were introduced in 1697. That's a long time ago. It's in the 17th century, almost 18th century. The stock markets were introduced a few years after that. Bonds are also from that time. So finance is really 300 years old. Why am I looking at the last 100 years? I'm looking at the last 100 years because this has been the domain where stocks have been, how can I say, most predominant. The stock market, although it started in the 1700s, it's really in the 20th century that has taken off. And and a lot of my examples of what went wrong have to do with stocks today. Okay, but that's the only reason. There's nothing magical about the 20th century. Nothing magical about stocks. It's just going to be a convenient storyline to justify some of the things that I want to be discussing today and in this course. And I want to start with the market crash of 1929. Now, I don't know if you know this. I suspect we talked about that briefly in previous conversations. But today this is going to be a very central element of what we will be discussing, because as you're about to find out, this was somehow the start of a new way of doing risk management and really a new way of doing finance. So what happened in 1929, we're going to see that in a little bit of detail today, but you probably know that there was a bank run, very massive bank run in the United States, which created a massive liquidity crisis in the banks. and it gave rise to the Great Depression. To this date, perhaps the deepest and longest financial calamity that we have observed in the world. In fact, it was so bad that many people argue that World War II was really just a way to get out of that financial predicament. I don't know about that. It's possible. Certainly, World War II had a very impulsive impact on world finance, and of course, in particular, the United States. But that's just to give you an idea of the importance of that. Now, the next period of time that I want to focus on, which will be very important also for us today, is the period around the oil crisis era. I don't know if you know how much history you know, but the United States and Iran had a very prolonged fight, arguably about the ownership of the oil reserves inside Iranian soil. And this created a very important element. Some of the things that we have discussed in the past, but today I need to adopt a very precise and mathematical treatment of some of these topics. And this was so bad that it created six bank failures in the United States per year. This has been, well, you will see. Every time we have a big bank failure, there's big headlines. This was a period when you had 6 of them every year. And this was really the reason that derivatives were created, and the reason that we spoke about derivatives in our course. And this led to the market crash of 1987, which is going to be a very important character in our discussion today. We'll understand a little bit why that happened, but especially the consequences of that that have lived. They're still with us. We can still see them. And then September 11 and Enron is not going to be a very important topic for us, but it did happen. It did have consequences. But that led to quantitative easing, a period in American banking where the government, well, actually the central bank, injected liquidity in the market through the purchase of banks, different bank paper. By doing that, introduce liquidity, a credit becomes cheaper, and interest rates go lower. And when that happens, then everybody's encouraged to borrow and to grow. That was the intended consequence of that. The unintended consequence of quantitative easing was that a credit bubble formed. The amount of credit was so large and was, in a certain sense, miscalculated and mismanaged that it structured credit and blew up in the year 2008. And this has been some of the sequence. So it's always what's relevant for us today is this chain of action, reaction. We're interested in the reaction because the reaction has been how a lot of the mathematical finance theories have been built. And as you can see here, many have been built from a risk management perspective. So it's very difficult to understand finance evolution without understanding these failures over the last 100 years, and in particular, how regulators reacted, how they changed the law, how banks and financial intermediaries reacted and changed what they do, their processes. And modern finance really cannot be understood without this historical perspective. I want to give you this historical perspective with some amount of details, and even focusing on how different theories were created as a result of that. Let me give you a summary of the event that happened and the regulation it gave rise to. So I already mentioned the 1929 crash. And the most immediate reaction to that was the Securities Act in the United States of 1933. Now you may say, well, this is the United States. I'm in Georgia. What do I care? or you say, I'm in China, what do I care? Or you may say, I'm in Germany, what do I care? Well, we care because the Securities Act has had very deep impact in the way assets are managed around the world. Now, this is a Securities Act. It had very little impact on banking. Banking was still not fully regulated by them. We had to wait about 50 years for that. This regulated the way assets are bought and sold, the way trading happens, the way asset management works. And I'll give you some examples of that. The Iran-US oil war had a very important consequence, which is the creation of the Basel Committee for Bank Supervision. This is an international body that supervises banking, central banks, and therefore the banking system worldwide. And this was as a way to address what I told you earlier, that we had about 6 bank failures in the United States per year. So this was an entity created to adopt that. Today we're going to be interested in some of the creations of this entity and how that created modern risk management, and the mathematics and information management that comes from that. Then the next event I will focus on today is the market crash of October 19, 1987. This was a very bizarre moment, very strange event. From an economic perspective, nothing really happened. The 1929 crash, as we will see, it was the economic circumstances of the 1929 market crash were very deep and important. The bank failures in the 50s, 60s, and 70s in the United States, especially in the 70s, were very well grounded on essentially a war between the United States and Iran. But the October 19, 1987 event, you cannot really find an economic explanation as to why that happened. Because there was really nothing economic that made it happen. What happened was something very new and very worrisome, which was that computers for the first time were starting to do automatic trading. And this was an event created by automatic trading of computers in the options market. That's not of interest to us. What is of interest to us is how the market reacted to that. And this is how modern risk management really happened. I like to say that modern risk management started on October 20, 1987. And this was, I also like to say that this is something very radical happened, which is that mathematics, for the first time, was written into law. I'll show you today what mathematics was written into law, and I'll show you the consequences of that. And I like to say that the reason many of my students get jobs in the financial sector is because of that fact, because of that mathematical entrance into the legal system worldwide. This is not the United States. This is for all the countries that ratified the Basel Committee resolutions. Okay. Canada was one, United States was one, Europe was one, etc. So, and then something else happened, and this was very unfortunate because the regulation that remedied the event of October 19, which is good regulation, it went into effect on January 1st, 1998. January 1st. So the banking sector had this sense of security that everything had been addressed, and now the banks were safer. And just a few months after that, on August of 1998, something very bad happened. The trigger were 2 events. On the one hand, Russia defaulted on their debt. That hit markets like thunderclap. That was during the perestroika period of Mikhail Gorbachev, and there was a lot of expectations that Russia would join modern markets, and Western participants were participating in the Russian markets, and in particular, they bought a lot of Russian bonds. And then Russia just defaulted on them, and it defaulted on them in a very weird way. Usually when you default is your last recourse. You devalue your currency first until you can't devalue anymore, and then you just default. Russia did it the other way around. They defaulted first, and then they devalued the currency. That's very unusual, but that was a surprising event and of great consequences. We'll see some of the consequences of that when I talk about trading strategies. I'm not going to discuss this topic today. But there was a second event, and that is when Bill Clinton, the president of the United States, was impeached in Congress. So two events happened, one in the United States and one in Russia, the same week. That threw markets into a tailspin, and the victim of that was credit markets. I'm not going to talk about credit risk management today. I'll talk about that probably tomorrow. When credit dries up, bad things happen. Markets need credit to happen. Companies need to borrow to grow. Governments need to borrow to grow. When borrowing stops, financial activity really stops. So this was a very bad period of time. It was so bad that a very well-known hedge fund at the time, long-term capital management, blew up, essentially. We'll go through some of the details of what happened there, but essentially it blew up. And that created a massive shock to the financial system in the United States, putting about $1 trillion of bonds at risk. $1 trillion is a lot of money. The GDP of the United States is about $40 trillion, all of it. So this is $1 trillion is just to give you an idea, is about the GDP of Spain or something like that. It's a huge amount of money. So that was put at risk. The Federal Reserve Bank had to step in and fix a lot of that. But the most important aspect for us in this course, not today, I'm not going to be addressing that today, but in this course is the creation of the second wave of banking regulation, which is called BIS 2. BIS stands for Bank for International Settlements. It was a resolution that member banks had to accept. And that was the second wave of that, created in 1998. Sadly, only a few months after the first BIS 1 was implemented. BIS 2 was so complicated that it took maybe a decade to actually get implemented and done right. And then there was Basel 3 and 3.5 and this and that. But see, these are the events that happen. When something happens, like Russia defaults and Clinton is impeached, then something bad happens and then regulation follows. And what I want to show you today is how that regulation affects the mathematics that were created, that were needed to manage that. Okay. Now, there's another event not relevant for us, very relevant for financial economics and accounting and audits and this and that, but not relevant for us. This is the Enron fiasco of 2001 that created the Sarbanes-Oxley Act of 2002. Okay, so there was problems with accounting, and then the market reacted. Well, not the market, the regulators reacted. Said, well, if you're a company that is publicly traded, when you report your financials, you have to report them like this. And these things that everyone used to do, you can no longer do. Now, this is not a course on that, so we're not going to talk about that. But you see the same action-reaction mechanism is there. The crisis of 2008 that you may know about, it's closer to your time, also had a big reaction, which also I'm not going to be discussing in this course, and that's the Dodd-Frank Act of 2010, introduced by President Obama in the United States, and to a large extent repealed by Donald Trump in his first mandate. Okay, but we're not talking about that. This is something which, by the way, all jurisdictions, Europe too, have attempted to copy in a certain way, and this is to limit banking activity, which in retrospect is what created some of the elements of the crisis of 2008. We'll discuss some of this when we talk about trading strategies, not today. Now, there's one thing which is, in my opinion, waiting to happen. Now I get into the science fiction part of this action-reaction discussion. And this is something will happen that will probably lead to data regulation. Data is already it's regulated somehow by regulators in different parts of the world, but we haven't had yet an event that will give a very clear direction for regulators as to how that will have to be regulated. By contrast, if I change industries and I go to the transportation industry, for example, the transportation industry, the airline industry in particular, it's very, very picky how software for airplanes is written. For example, just to give you an idea. We don't have that for banks. Central banks are taking and analyzing the models that are used, but we are not at a point where data is being regulated, but I suspect it's coming. I don't know, maybe yes, maybe not. Another event that happened is COVID-19. COVID-19 has not had a very clear regulation response, but I suspect it probably will. We're still suffering some of the consequences of the inflation that COVID-19 caused. We haven't seen a big reaction. Maybe we'll never have it. A lot of the inflation is now being caused by other factors, such as the geopolitical change and the breakup of supply chains. So maybe this will never become a regulated response. We don't know. I will see. And sorry. And the last one that I want to mention in this action-reaction summary of the 20th century is a climate risk. Climate action has had a response, a regulatory response, which is Article 2.1c of the Paris Accord, encouraging, actually mandating the financial system to be the mechanism to provide finance flows for decarbonization. Okay, so that's another good example. I'll discuss that when I talk about sustainability and sustainable finance and all of that. That will not happen today. Okay, so with that mindset now, that when something happens, there's a reaction. And today we're interested in the reaction because the reaction is what creates jobs. And this is what creates processes inside the banks. I want to now give you the 100 years history of risk analysis, how this has affected risk, the risk sector. And I want to start with the beginning of value investing, not because it's really risk analysis. Risk really did not exist back then, as I'm going to show you next. Risk really started in 1950. But what happened here is a very interesting reaction of a reaction. We saw that the reaction was the Investors Advisors Act of 1933. One of the things that act did in 1933 is the creation of reliable accounting. So if you now have reliable accounting, you can use accounting information to make investment decisions. And this is what value investing really is all about. So that was a very interesting consequence of a reaction. Okay. Now, more interesting for us is what happened in 1950 when Harry Markowitz, actually a graduate student at Stanford, I believe, for the first time he thought about this, is he thought about risk as something that should be taken seriously in the financial sector. And he wrote his famous paper on portfolio selection, something that we've already seen in this course earlier, and something which, we're still benefiting from his thinking, although this is a very, very old topic. And all of that somehow, it was multiplied by big factors as the personal computer arrived in everybody's desk. The personal computer had the effect that now not only big banks could come up with theories and regulators could come up with theories, but you had individuals, individual traders, individual risk managers that could develop their own systems. They could try things out. And this has created a tremendous growth for a lot of theories, methodologies, implementations, so on and so forth. And now we are in a period where all of that is maximized by the arrival of artificial intelligence, machine learning, natural language processes, large language models, and all of that are empowering our computers, whether on our desk or on the cloud, to help us achieve more. And this is, as you can see, a very interesting growth from 100 years ago, when accounting was created, reliable accounting was created, when a single number started a revolution of trust, to a period now where we have billions and billions of numbers that we don't fully trust, and we don't really know what they mean. We don't even know where they come from. But there's so many of them that we're beginning to take actions based on the results of, for example, large language models. They just tell us something and we act on that. Okay, very interesting evolution over only 100 years. And what the future would look like, I don't really know, but I am sure that technology in AI form is going to be a part of that. We will see. We will see. One important application of all of this is the impact that surrounding topics, and in particular social action or social activities such as climate risk or water management or health, well, it's going to have on the financial sector. I believe it is going to be the source of innovation for the future, but at this point that's speculation, so I'm just going to move away from that. All right, so this has been the summary of what the last 100 years have been. When we talk about risk, I want to introduce the classification of risks, what I call risk taxonomy. What risks have we really done and have we really learned about? And this is something that we've already seen. In fact, this is something which came up for the first time when we looked at our example of the fund that we created, but now I want to address this from a banking and regulatory perspective, and so I can explain the different topics that were created. The first one is market risk. Market risk is the loss of value due to changes in asset prices. Value is denoted by NAV, which stands for net asset value. And simple example is you buy a stock, the stock goes down, then you lose money. Or you buy a bond, interest rates go up, the bond goes down in price, you lose money. This is the first type of risk that we're going to be considering, and it's called market risk, and it affects the value of your securities. And I'm going to spend the day today talking about just market risk. On a different day, I will be mentioning credit risk. Credit risk is the loss of value due to default events. Your counterparty does not pay, your counterparty has worse quality, and now you begin to even suspect that he's not going to pay. That's going to decrease the value of your securities involving that counterparty, and so on and so forth. This is a very important topic. A full lecture will be devoted to that. Liquidity risk is a delay in turning your assets into cash. This is hard to explain, but when it happens, you never forget. Imagine the situation that you're a very rich person, very rich. You typically don't have your money in cash. Rich people tend not to have money in cash. That's why they are rich, by the way. They have investments. You have a house that's worth a lot of money, for example. But now you need money quickly. You have to pay a fine, big fine. You can't wait. You have to. How can you access cash? Well, sometimes you can go to the bank and you get a loan against your assets. If for whatever reason the bank says no, or the money you're asking is too high, and what can you do? I mean, it is not that you don't have the money. You have assets that are worth a lot of money. Earlier, we have discussed how, from a finance perspective, we do not distinguish between cash or an asset that's worth something, because we've always assumed you can turn one into the other. But that in practice is not true. It takes time to sell your house. It takes time to even get to borrow money using a very difficult asset as collateral. So when that happens, that that situation is a liquidity event. And a very good example of that is what happened to the Hunt brothers around in the decade of the 80s. The Hunt brothers were two Texas billionaires. They had a lot of money. I believe they owned the rights to oil in all of Alaska, just to give you an idea of their net worth. But they decided to trade the silver market. And they traded the silver market very successfully, so successfully that, well, they made money, but also they made the price of silver go through the roof, to such an extent that one day, just one day, they were hit with what was approximately $1 billion margin call. The margin call is something which we're going to also explain another time, but basically they had to come up with $1 billion in 24 hours. How can you do that? Well, they couldn't. They had to sell a lot of assets worth much more than $1 billion so they can turn the $1 billion into cash. It's a very good example of that. But perhaps a better example of that is the firm that I already mentioned to you, Long-Term Capital Management. Long-Term Capital Management was this hedge fund in the United States that had two fantastic directors called Myron Scholes and Robert Merton, who had won the Nobel Prize for Economics in 1997. And in 1998, they were a victim of the credit event I mentioned earlier. 1998 is when Russia defaulted and Bill Clinton was impeached. And their trading strategy, which we will see at some other time, which was a very good strategy, it was guaranteed to provide a positive cash flows with very, very small market risk. They had the problem that they, again, were hit with a margin call. So a lot of the securities that would have produced them cash flows in excess of their liabilities had to be liquidated. And in liquidating that, you incur into very big losses because you have to sell them fast. You cannot optimize the price, and they lost billions of dollars, and actually the fund just went down. So that's another example that your delay in turning your assets into cash can cause severe damage. Okay, and this also is something which I'm happy to tell you, because earlier I had mentioned how when we're doing option pricing, for example, or when we're doing finance, we do not distinguish between cash and something that's worth cash. Now we do. And we see that that relationship is a very big source of risk that we call liquidity risk. Sorry. Now, gap risk. What's gap risk? Now we're getting to the more esoteric aspects of risk, but this is very interesting. And if you go to a part of the world, perhaps where you are, where stocks, for example, or bonds do not trade in very large volumes or very frequently, sometimes your portfolio, the way you do the analysis of your portfolio is you have a certain security and you typically price that security at the last traded price. The last traded price could be completely off. Maybe sometimes stocks do not trade for a whole year. And when they trade, the price only drops by 50%. You don't have that ability to update prices like you update when you have your stock portfolio, for example, in the New York Stock Exchange. So what that does is it creates stale prices, which are perfectly good from an accounting perspective, but they give you the wrong valuation of your portfolio for any practical purpose. So when that happens, you actually have, it's called a gap, because you have a certain price that you are being trading at, and then suddenly the price drops or goes up. But you have that big, and that is called a gap risk. It has to do with the mechanics of how financial transactions happen and the need to report transactions based on the actual prices and not invented prices. Now, legal risk is an example. We already mentioned that when we discussed the very interesting case of Bankers Trust and Procter & Gamble. when Bankers Trust was sued by an individual shareholder of Procter & Gamble because the shareholder was upset about the swap that was sold from Bankers Trust to Procter & Gamble, accused Bankers Trust of gambling because the shareholder argued that option trading is gambling, and gambling is illegal in the state of New York. We went through that. It was remedied by showing that, in fact, option trading is not gambling and replicating portfolios exist, and it's just a way to express financial certainty in a different way, in a way which is convenient for customers, so they don't have to do all of the complicated replicating portfolio activities, including the rebalancing of the portfolio, and that saved the day. But if that had not happened, the consequences would have been tremendous. So that's a very good example of legal risk. You do something which is perfectly legal today. I'm not saying that you're doing anything illegal. That's a different type of risk. But then you were doing something which is great. And then suddenly something happens, and lo and behold, you have to change what you're doing, and what you're doing is now illegal. So you have to liquidate your portfolio or somehow get rid of it. And that can cause losses. And the last one, the last taxonomy discussion I want to have on on risk today is operational risk. Operational risk is, in a certain sense, a catch-all phrase. We have been doing this taxonomy, identifying very carefully the sources of losses, and if the source is this, is market, if the source of that is credit, if the source of that is something else. When it comes to operational risk, it's somehow a catch-all phrase. Everything which does not fit into any of the previous categories is called operational risk. Operational risk, for example, involves if you make a mistake. Where are mistakes in the previous taxonomies? They're not. It's a mistake. So a mistake causes losses. So where do you put it? Operational risk. Okay. Fraud. Someone steals your money. Where do you put that? Operational risk. Cybersecurity. Someone breaks into your account and steals $5 million. Where do you put that? Operational risk. Okay. So operational risk is a very important type of risk. This is an area which is very interesting from a regulatory evolution perspective, because operational risk was at some point part of Basel III. The regulators for the bank supervision, the bank supervisors, they started to regulate operational risk, hoping that just like market risk regulation and credit risk regulation had succeeded, they hoped that they could regulate operational risk. And they came up with some regulation that was very simple at the beginning, and then they became very ambitious, propelled by Europe. Europe has been always the leader in operational risk, and perhaps the reason is that in Europe there's a very sound knowledge of sophisticated techniques. I don't know if you know of a French or German engineer. They can really do wonderful things. So when it comes to banking, they went and created something which is called advanced models. And this was hoped to be the objective of where banking regulation would go. And it looked that they were able to allow the calculation of operational risk, these very hard to control quantities. And they were mathematically very, very sophisticated. And there was a time when I used to lecture about this, because it looked like this was going to be a source of jobs for my students. I usually like to lecture on things where I see jobs coming, so my students can take advantage of the new jobs. And it did look at some point that this was going to be the case. It was not. This was so complicated that at the end of the day, a lot of the objectives were dismantled, and they were rolled back. The advanced models were repealed and they were eliminated from regulation. This is a very interesting example of regulators backtracking on their regulatory steps and somehow actually abandoning some of their objectives. Okay, so this gives you, I hope, this gives you a very good summary of how risk is thought about. Risk is typically, or risk management is typically not about avoiding losses. Losses is just part of the business, is what you do. It's just to have a disciplined approach to doing everything you do every day so that you can minimize losses, so you can have the proper processes so that your activity is consistent with best practices or analogs to that. Okay, so this is what this is how risk management is done. And this gives rise to this risk taxonomy gives rise to a type of risk classification, which I want to address. I want to explain this to you by looking at it in these three verticals that I have. I want to tell you the taxonomy that we mentioned earlier, and I want to address it from three verticals, because if you're in the banking sector, if you're in the insurance sector, or if you're in the asset management sector, these things look very different. So I guess you know, banking is the activity that banks do. They essentially borrow and lend. That's what they do. They can give also financial services, like for example, they can sell you options, or they can sell you protection, you can sell you mortgages. Okay? It's just advanced types of lending. Insurance sector is different. Insurance sector is you pay a premium, and if something bad happens, they pay you. If nothing bad happens, you lost your premium. And that's what the insurance sector does. And the asset management sector is different. You give them money, they give you your money, and they invest it for you, and they give you more, sometimes less. So these are the three basic verticals that I want to address for the financial sector, and I want to show you how our risk taxonomy affects these different types of activities. I'm going to start. I'll have to take a break in 10 minutes, and then we'll continue. This is something which is also fairly involved, so I think a good break is going to be something that you will appreciate. So the different types of risk that we have here in these verticals, I'm going to start with the taxonomy of market risk. Market risk has been implemented in the banking sector through a variety of Basel resolutions. I mentioned here Basel 1 and Basel 3. Basel 2 is missing because Basel 2 is going to be for credit risk. So 1 and 3 are examples of regulation that the banks have had to do. Basel 1 is the one that happened as a reaction to October 19, 1987, and it created this concept called value at risk, which I will review in great detail for you today. And we're going to do examples and calculations and this and that. And this is a creation from essentially the year 1991 or 1994, depends how you look at it. And you'll understand all of this in just a few minutes. But then this was revised in Basel III, which was perhaps also another consequence of the crisis of 2008. And the one topic which I'm not going to review in this lecture, but I will just mention to you, is this gave rise to a very important acronym in banking, which is FRTB, the Financial Review of the Trading Book. And as banks have prop desks and they trade on their own assets or the assets of their customers, this gives rise to losses, which had to be calculated from the perspective of the trades they have on their books, which have not closed yet. Okay. Now, from the insurance perspective, market risk is the main element that Solvency II, which is the European regulatory system, is the most advanced, has been created. And in particular, market risk is characterized in one element within Solvency II, which is the Solvency Capital Ratio, SCR. This is not something I'm going to be addressing in the lecture. I'll address value at risk, which is very similar, and I'll just focus our attention on that. If you understand value at risk, if one day you have to understand Solvency Capital Ratio, it's not that more difficult. Now, for the asset management industry is not regulated from a market risk perspective. Why? Because it's your money. If your bank goes bankrupt, like it happened in the 70s or it happened in 2008, that's bad for the system. So the regulators care about that, but they don't care if you lose money. That's your problem. It's not their problem. Regulators don't get into that. What regulators care about is other things when it comes to the asset management sector, as we're about to see as we go down the taxonomy. But this is not an area that regulators care for. Let me tell you a very important consideration here, which is oftentimes misunderstood, even by some financial professionals. Long-term capital management. Long-term capital management was a hedge fund. They lost everything, almost everything. And it created Basel II. It created the regulatory framework Basel II, as I mentioned earlier. But the reason that Basel II was created is not because this hedge fund lost everything. They couldn't care less. It's the investors' money. The reason they care is because this fund was so large that it could have created tremendous damage to the banking sector. In fact, it was going to create tremendous damage to the banking sector. And now the regulators care. So this is something which is misunderstood. And some people even think that the regulators, the Federal Reserve Bank of the United States, bailed out long-term capital management. No, they bailed out the banks, maybe, but not long-term capital management. Okay? When you have when someone is managing your money, when you're doing investment, the only area that regulators care for is the Consumer Protection Act, which is that if they're selling you a product, the product could lose you money, that's okay. But make sure they don't lie to you. Very similar that when you buy milk, you look at ingredients and say, yes, it is milk, it's not something else. Basically, that's the level of regulation that goes into the asset management sector. So you see, this is interesting, and I want you to, as you will have a career in the financial sector, I want you to understand that an asset manager, say BlackRock or a pension plan, is very different from a bank. Not only they give you different products, but they also care about different things, and they're regulated differently. And the mathematics and the technology which is used to make them work are also different. And when you go to an insurance company, yet again, something very different. An insurance company works very differently from a bank. Insurance companies, interestingly enough, they have parts of their business which are asset management. Why? Because insurance companies, they collect so much money from premium that what are they going to do with that? You have a lot of money, and what are you doing? Just waiting for the losses to happen and the claims so you can pay out? Yeah, you can do that. But while you wait, why don't you invest your money making sure that the money grows? Because the future liabilities will be higher than your calculations indicate today because of things such as inflation. So insurance companies always have the need to invest their own money, not someone else's money, their own money, so that the claims that will happen in the future can be met at the money valuation for the future and not the money valuation today. Okay, so insurance and asset management, they are very close together. Because insurance companies need to invest, but the regulation is very different. Okay, and insurance companies are regulated through Solvency II and the Solvency Capital Ratios and this and that. Okay, the next topic I have here, the next taxonomy, is a credit risk. Maybe I cover this and then we take a break. Credit risk, when it comes to banking, we already mentioned what it is, or already mentioned to you the an example of an event that gave rise to a very big credit event that was long-term capital management, and this was what Basel II came up with. Now, this is something which will be addressed in a different lecture, how credit risk is regulated, and in particular, the creation of credit value at risk. Today, we're going to focus in on this lecture on value at risk, not on credit value at risk. Okay. And in Basel III, there was also a chapter on credit risk, which was the credit value adjustment, another byproduct of the crisis of 2008. When it comes to insurance, credit risk is also part of the calculation for the solvency capital ratio. And when it comes to asset management, credit risk is something that it's actually a source of revenue for them. As you can see in my legend of this table, I have three font colors that I use. One is red, which refers to regulated activity. One is black, which is good practices, but unregulated activity. You do it if you want to. But then the green one is activity which actually you do so you make money. And credit risk, which is a source of risk for a bank, is actually a source of revenue for an asset management corporation. They can take advantage of that, as we will see in a different lecture, how asset management companies can take advantage and actually compete with banks when it comes to credit risk and their ability to produce revenue. The two main pillars of risk management are market and credit, okay, as I mentioned. Now, operational is something which I mentioned earlier. It's a bit of a failed attempt. I'll still mention something about this. In the banking sector, it was regulated for a period of time, but then it was somehow abandoned by the regulators. They may make another comeback. In fact, I suspect with appropriate databases and the use of machine learning technology, we may see a renewed version of that coming up, but this science fiction, nothing like that is happening right now. It is not really regulated in the insurance sector and certainly not in the asset management sector, although, fraud is very important. Liquidity risk is another area which is also not regulated yet. It's still being, there's little pockets here and there, so we're not going to be dealing with that. I have some examples here, but I'm not. Gap risk also not regulated. As you can see, this is something which is not, it's from a regulatory infancy, and therefore there's very few standards. Today I'm going to talk about standards, and there are no standards there. Now, when it comes to legal risk, it's the same thing. It's also not regulated. Of course, there's armies of lawyers and something that banks have to take very seriously, but also something that is not there. Cybersecurity is a different topic, though. Cybersecurity is, well, it's not regulated now, but it's perhaps the biggest activity of every bank risk manager. So I suspect it's going to be regulated very soon. We already are beginning to see some best practices coming up. And when it comes to asset managers, they are perhaps advanced of the banks. The Securities and Exchange Commission in the United States has already indicted several companies for data protection breaches, for example, okay, or for not enforcing disaster recovery plans appropriately. So when something goes down and you lose your data, then you cannot recover. So this is an area which I think is going to be very different in a few years than it is today. I think it's perhaps the one where biggest activity is going to happen, but as of today, not really very much. With one caveat, which is that in the insurance sector, cybersecurity is actually a revenue generator. Insurance companies are selling cybersecurity policies, which is interesting when we see how regulation is going to be entering into that space. Okay, so, all right. So, associated with this are a number of business cases. These business cases perhaps is something that I would like to jump over today. Each of them requires proper analysis and a lot of time. So maybe let me just move over to the next one and talk about risk management from the modern perspective. I mentioned earlier that the Basel Committee on Banking Supervision was created in the 70s, more or less, for the adoption of a prevention of bank failures. And perhaps one of the first tasks that they did was to create the Basel One. The Basel One started on really as a consequence of the market crash of October 1987, and that was in 4 years after that. The Basel International Treaty was signed by a large number of member countries that started a new direction of asset management in the financial sector. One of the big landmarks there was the creation of the risk matrix methodology of J.P. Morgan. Let me try to explain how this happened. It's a very important description of how regulation happens. When the Bank for International Settlements created the Basel International Treaty, they called for certain measures for risk management to be considered, but they proposed no methodology. They only proposed certain objectives. At that point, one bank, J.P. Morgan, which was of course going to be regulated by that, they came up with their own methodology. Somehow what they did is they did the work of the regulator and then just proposed the regulator to accept it. It was a pretty good piece of work. It was very elaborate, very long, so I can only imagine regulators were very happy to accept it, so the job was somehow done for them. Today we're going to see the relevant contents of the the risk matrix methodology of J.P. Morgan. Okay. And this was the creation of a Basel I on market risk, which is what I'm discussing in this lecture. In 1997, in advance of the big credit event of 1998, J.P. Morgan produced Credit Matrix, which as a way to regulate a credit, but it didn't happen. What happened is that in 1998, long-term capital management blew up, put the financial system at risk, and then Basel II came up as a consequence of that. And then a version of Credit Matrix was also adopted as part of Basel II. And as you can see, JP Morgan has been the bank that has been proposing methodologies to be adopted. And then Basel III came up with enhancements in market and credit, as we saw, and then operational risk that was eventually rolled back. Before I get into the details of that, I want to give you another timeline of the regulation for the asset management industry, not for the banking industry. And this started right after the crash of 1929. The Investor Advisors Act was created in 1933 and 1934 that regulated the creation of the Securities and Exchange Commission as the regulatory body in the United States. Then Enron happened, Sarbanes-Oxley, as we saw earlier, action-reaction, 2008, the Great Recession with the credit bubble exploding, and then the Dodd-Frank as the reaction to that. Okay, now, when it comes to asset management, just to give you a sense of the radical changes that happened after the market crash, let me tell you what was happening before the market crash of 1929. In the 20s, 1920s, something called the Roaring Twenties was essentially a very big speculative boom where net profits of companies showed an increase of almost 40% over the previous year. So there was a lot of enthusiasm about participating into this new market called the stock market that had been already there but restricted to a few. Stock markets were democratized in the 20s, and then investors just went en masse to invest in stocks. In fact, the speculation was so high that there was more money on loan to people to buy stocks than there was money in circulation. This is a big deal. Imagine that. More money was invested in stocks that there was money flowing in the market. Okay, so the result of that was what? Of course, the times were good, but there was tremendous amount of inflation created, asset inflation, because of that. And the average PE ratio was 32 in September of 1929. 32 is very, very high, Right? So 10, 15 is normal, but 32 is about twice as big. So you can argue that prices were inflated, very, very inflated. But this is the interesting example that I want to tell you about pre-1929. This is the story of Albert Wiggin, the head of Chase National Bank. When he saw that problems were coming, he shorted 40,000 shares of his own company, Chase National Bank. And then he made a $4 million profit. $1 million of the time he became rich by shorting his own bank. You cannot do this today. Today, this is called insider trading, and you go to jail if you do it. But back then, it was allowed. Again, there was no regulation. So he was just quick at making a profit when he saw his bank was going down. This is a very good example that will tell you how a regulation can actually affect the way things work. Now, in 1974, the Basel Committee on Bank Supervision was created. So we're talking about now, almost 50 years after that, in the big turmoil arising from the Iran-US oil war. And the way this was regulated was as follows. I want to show it to you, and it's just all in the simplicity of it. The way banks were regulated up until 1992, this is before Basel I was created, was as follows. Capital had to be placed with the central bank. So if you're a bank and you have a certain number of assets, then there's a calculation, which I want to show you. The result of that will be a number, and this is the number that you have to leave with the central bank so that if something happens to you, they will use that money to recover some of your losses to other people. Okay, again, remember, this is an area when we had 6 bank failures every year. This is a bank failure every 2 months. So the idea was banks are going to fail, they are failing. I'm going to ask them for money so that on the one hand, because I asked them for money, they're going to do less business, so less chance of going under. And if they do go down, I have money that I can use to recover losses for others. And this is the creation of the risk-weighted asset. And the way this was done was as follows. You had different types of securities, cash, central bank, government debt. All of these carried a risk weight of 0. They were considered to be riskless assets. You don't have to, if you have these, you don't have to put up capital. You have cash, don't worry, just keep it. If you have development bank debt, if you have OECD bank debt, if you have other types of securities and this and that, then 20% of the value of that was part of the calculation of the risk-weighted asset. So 20% of that was considered to be your risk asset, and you had to take that number, multiply by 20%, and that's where it was. If you had residential mortgages or things like that, then 50% of the value of that was part of your risk asset calculation, and all other debt, corporate bonds, and this and that, 100% of that was considered to be part of your risk calculations. You take all of that as part of your accounting. This is what accountants would do, right? They take all these assets and say, well, this is the number, this is the number, this is the number. Then you multiply by the risk weighted multiplier. So cash 0, development bank 20%, mortgages 50%, all other debt 100%. You take that, and 8% of that has to go to the central bank. That's how banks were regulated. We can mention many things about this, but my favorite comment about this is that this is a linear system. A linear system. You add something to your bank, then you see, let's look at the value of that, and then a piece of that, a number, multiply that, is what your risk asset is going to be. It's a linear system. Now, let's look at October 19, 1987. October 19, 1987, what happened is that automatic trading of stock options created a volatility bubble, which caused the market to crash 25% in a single day. 25% in a single day is a lot. Now, mind you, the market recovered and like nothing happened. This is not something that was created by economic conditions. It was just a trading fluke with these markets the way they work. But what was realized is that these new instruments created in the 80s called options are nonlinear instruments. So capital ratios on risk-weighted assets, which were linear functions, they were determined that the regulation that was there in 1992 was inappropriate for it. And I'll give you a good example of that. Remember that game we played? We have a stock. If the stock goes up from $1 to $2, I'll give you $1. If it goes down from $1 to 50 cents, I give you nothing. You remember that. This is the example that we've used over and over and over again. Great. That option is a nonlinear instrument. Because if the stock goes up by 100%, the value of the option goes up by 300%. If the value of the stock drops by 50%, the value of the option drops by 100%. There's a nonlinear relationship. We can see that very clearly in that simple option. And all options are nonlinear. The effect of markets on the options changes as a function of one number, which is called the delta of the option, of which I will say more today. So what was realized at the time is that if you have a market full of nonlinear instruments, you cannot have a linear risk management policy. At the end of the day, that is what happened. And what was created, what was considered, and actually what JP Morgan proposed as part of the risk matrix methodology is an out-of-sample loss-based measure that would not be linear, that would be able to take non-linear effects into account. So let me explain what this measure is. This is called the value at risk. And now I'm ready to define it. You understand all the consequences, all the historical consequences around that. I don't like to talk about value at risk in isolation as a mathematical object, because then what happens is, well, as a mathematical object, it's very, very imperfect. You look at it and you say, well, why is the worstness? I can do better than this. But that's not the point. The point is that it was an evolution from something that was already there that was much, much worse. And to make it short, I would say that value at risk is going to be your worst day loss in a 1 month period. Your worst day loss in a 1 month period. Of course, you're going to do this looking in the back, but especially on a proactive manner, looking into the future. I'll show you how this is done. Okay. Now, the important thing here is that this is a mathematical concept that made it into law. I will show you which mathematical concept. We've already seen it. I'm just going to identify it for you. It's a mathematical concept you already know. When you talk about your worst day loss in a month, you're talking about a quantile of your loss function, something we already saw, but now it's going to come up from a risk management perspective. And this was the single development that, in my opinion, made mathematics be relevant inside a bank. So let me explain it to you in different ways. First, I want to give you the actual definition. The value of risk of a portfolio always has two numbers attached to that. One is the confidence level, and today I'm going to assume 95% or 99%. Okay, 95%, that's the confidence level. And the other is the threshold, which is what value at risk is going to be. In other words, I will say that the value at risk of a portfolio with 95% confidence is equal to a certain number if the probability of losing more than that number is 5%. This is a quantile. I'll explain this with more detail. But just stay with this for a minute. The probability of losing more than X is 5%. That means that if you have a certain loss or a certain number of losses, let's say you have 20 losses, out of 20 losses, 5% is the worst one, right? So if there are 20 trading days in a month, that basically means it's the worst day loss in a month, right? So it's what I said earlier in English. Now it's expressed into math. Now the math is still not very precise. I want to make it more precise, and I'm going to write it like that. Now, please, when you look at this equation, just be aware that everything that's written here is the worst one-day loss in a month. That's really what it is. I'm just writing it down in mathematical terms. And if I have my loss distribution density that I denote by R, I'm going to write on my iPad here so you can see what I'm talking about. The value at risk is defined here. It's defined implicitly. If I look at the expected, the probability that I lose money over and beyond a number called value at risk, that is going to be less than the 5%. You can see my confidence interval is here, is my alpha. So this statement that I say here, that the variable portfolio with 95% confidence equal to X, is the same as saying that the probability of losing more than X is 5%, is exactly what this formula here expresses. And you know that the integral that I have here is the same as this probabilistic statement that I'm making here. The probability that the losses exceed this number value at risk has to be 1 minus the confidence interval, 5%. The probability that I lose more than value at risk is 5%. Do you understand this?
Yeah, sure.
Good. This, I suspect this is easy for you because you have a mathematical background of some sort and this and that. But I want you to be aware how radically different this is from the way risk management was done before 1992. And I want to bring back another discussion we have had in another lecture, which is this formula we have here is okay for a lecture. But if you are in a real market with a real bank and a real regulator, what does this mean?
I think this is this calculates the amount the bank has to deposit as a margin.
It is. But let me ask the question differently. How does the bank calculate this number?
Based on the assets.
No, it's based on the asset, but how do you do it? What is the algorithm? Someone will have to program this into the bank's systems. And
well, it's gonna be like summation of every single assets.
Continue.
Weighted probability of that.
Oh,
Weighted
okay.
average.
No, hold on. Yeah, you just mentioned the magic word, the probability. How do you calculate the probability?
Well, from historical performance, maybe.
Well, this is it. This is the important part, because in a math class, we ask you to calculate probabilities all the time. But now, imagine you go to a judge. There's a dispute. You think that probability should be calculated one way, and I think it should be calculated a different way. In a university context, I'm right. But in an industrial context, the judge is going to define who's right. How many judges know how to calculate probabilities?
Probably not a lot.
Probably not a lot. Their job is not to know probabilities. Of course, they can always use expert witnesses and this and that, right? But what I want you to be aware, and this is very important, I need you to be aware of this, of how revolutionary this was to introduce a term like probability into law. This is like introducing quantum mechanics into law. How can you do that? We have, let's go through examples where these things are done into law. The speed of a car, for example, that's physics. And it's part of the law. You get a speeding ticket, and the police can prove that you were going at a certain speed. How do they do that? Because there's a laser, and this has been accepted by the law. And there's a machine that says this is how it's done. But we don't have such a machine that calculates probabilities. In fact, what happened is that this was the beginning of a whole new business. There was the risk management business, was just like you have radar detectors that calculate the speed of vehicles. You had to have systems that calculate the risk of banks. And this, in my opinion, was the big change that happened in the 90s. Because this created an industry outside the banks and inside the banks that would have to hire people with mathematical knowledge, people like you, who would know what I'm talking about here. There would be teams that would understand how judges think. These are the lawyers. And then they will be working together to make these things happen. But I want you to understand that this is not a textbook exercise. This is a massive change for the financial sector that started with the introduction of these 4 letters into law. Probability. And this has been a great generator of jobs for students like you. Just this. One could argue that banks like to do risk management because they don't like to lose money. That's true. They don't like to lose money, but they don't like to give money to the central bank either, which is what this is about. So this is not about losing money. This is about giving money to the central bank for them to keep as collateral. Understand? So what would a bank prefer? That the value of risk is high or low?
Low.
Low, because if they give less money to the government, to the central bank, to the regulator. Right?
Right.
Would you argue that, oh, they would like to be high so they're safer? So, well, I'm not sure I could lose $1 million or $10 million. So I'm going to assume I'll lose $10 million and then I change my business. Well, maybe they do that internally, but they're not going to tell anybody. They're not going to tell the regulator. Because it's like if you're driving a car. What would you tell the police officer? That you're driving below the speed limit or above the speed limit, if you're not sure?
I'd say probably.
You'll tell the police you're driving below the speed limit. Now, when you're actually driving and deciding what speed, if the road is dangerous, you're going to slow down. Okay. If there are no risks, you may speed up. It's your decision. But when it comes to reporting your speed, you will always report the lowest number you can. So this was, in a certain sense, what the banking sector was facing back then, except that they had to hire people to conduct this, or to build these machines, internal and external, that will calculate these numbers. And this is not easy to do. Because although it fits in a page, it fits in one line actually. To do this in practice is very complicated. What's the value at risk of a mortgage? Banks have a lot of mortgages. They have millions of dollars, millions of mortgages actually. How do you calculate the probability that a mortgage loses money? A mortgage is a very complicated option. What if rates go up? What if the clients prepay money? I don't know how much you know about mortgages, but they're very complicated instruments with very complicated risk factor settings. They are very difficult random variables. So this is a very important point that I want you to make, that I want to make to you, which is, in my course, I will have to do some sophisticated considerations for calculations of probabilities and things like that. And the reason is that in the financial sector, I'm going to have to do it. And I'm going to have to do it so good that I can defend it in front of a judge if that might be the case. And even a product which is very common, like a mortgage, has a lot of factors in it, which are very tricky to model. We already know that if you have a fixed rate mortgage and rates go up, if you didn't hedge, you're going to lose money. That's true. If rates go down, you may think you're making money because you locked in some higher interest rate payments from your customers. But the customers can prepay. And you don't know when they will prepay or how much they will prepay. In fact, one case that was very famous in history is a hedge fund that had a very good mortgage portfolio. And right after 2001, when rates went down dramatically because of quantitative easing that we mentioned earlier, mortgages just had a wave of prepayments. Why? Because customers could prepay the mortgage and get a new mortgage at a cheaper rate. The result is this bank went bankrupt. Sorry, this hedge fund went bankrupt. It was a hedge fund, it was not a bank. But goes to show you that in finance, oftentimes you have very complicated probabilistic situations. So when in a few days I lecture on probabilities and how we do this and how we do that, this is partly the reason. We need to understand that very well. Because not only we will have to implement things which are complicated, we will have to probably defend it in front of a judge if worse comes to worse. Okay? So this is a climatic point in my lecture today because of the historical significance of the introduction of these three letters, P-R-O-B, into law. And whenever math becomes law, that's jobs for mathematicians. Okay? These are not textbook exercises. These are very, very important things. Very, very important things. Okay, so this, we just opened. Everything we've done so far has been almost 2 hours of preparation for you to understand this because, and I always like to do it like that. I could have started with the definition of value at risk, and there you have it. But then you don't understand it. You need to understand the consequences, what led to this, and the fact that this was regulated in 1991. It went into effect in 1998. We already had computers back then. So this is something that could be done. It was a little bit at the edge of what computers could do. I'm telling you. Banks had millions of positions. And each of those positions depended on many variables, sometimes 10, sometimes 100 variables. And now you need to do a probabilistic statement about a very complex portfolio under very different considerations with less computational power than an iPhone. That was the 90s. I want you to understand this. Okay, so let me continue. Let me show you some of the things that happened here. The first thing that I want to do is I want to make contact with something we have seen in the past. We've already seen this in the past, which is if you have a portfolio, then the portfolio has the cumulative distribution function. It's exactly the same graph we saw in a different lecture. And then we talked about the probability density, and we discussed how one is the derivative of the other, how the derivative of the return, cumulative return distribution function is the return density. We saw that, and we saw this in the context of asset management, understanding portfolio performance, and this and that. But now we have a different twist, a different interpretation of this, because look at the green curve. Forget about the yellow curve. The yellow curve is the one that everybody knows, because everybody does histograms and Excel does histograms for you and this and that. But look at the green curve. What's the green curve telling us? Look at that X value on my X-axis. What's the value on the Y-axis? the value of the y-axis is 0.25. What does that mean? That means that the probability that my portfolio is worth less than x is 25%. That's the value at risk. Of course, if my confidence level is 95%, then I have to lower that and I have to go to the level of 5%. Let me show you. If 5% is here, I cannot really tell, is there? Then my value at risk is that. That's how much money I can lose. So the cumulative distribution function, defined probabilistically with a very simple formula, has an inverse. The inverse is called the quantile function. It's the one that maps from the y-axis to the x-axis. That's the inverse function. F inverse. This is the function that gives us the value at risk. Where here what we have is the confidence interval. We've already seen this. We haven't seen anything new. We just saw a different context in which this is applied. And this was the big contribution that JP Morgan did, in a certain sense, as I'm about to explain to you, for this particular object called value at risk. Okay? But again, don't forget, the calculation of this is very sophisticated. For a real portfolio in a real bank, very complicated. This green curve is nice, but to calculate this curve is very complicated. In fact, let me show you a very simple example, which is already very surprising at the same time. Imagine your portfolio is a very simple example. It's a very simple portfolio. You have 1,000 lottery tickets that you just gave to people. And the winner, you have to pay $1 million to the winner. You can imagine that, right? Lottery tickets, 1,000 of them, and you give them to the winner. You give $1 million to the winner. Let me consider different portfolios with that. In my first portfolio, the portfolios are all going to be a function of how many lottery tickets I give. Imagine I give one lottery ticket to only one person. That's my portfolio. I can be unlucky, and with a 0.1% probability, I will lose $1 million. What's my value at risk if I only give one ticket away? It's 0. Because the probability that I lose $1 million is less than 5%. You understand?
Yeah, sure.
Now, does this mean that my risk is 0? No.
Yeah.
My risk depends how we measure it. We're not doing that right now. We're just saying that the value at risk is 0. So if this was a bank, and the bank had a single position in their portfolio, which is this lottery ticket, the central bank would say, oh, don't give me anything. The value at risk is 0. Let me assume that now you've given 49 lottery tickets to 49 people. The probability of losing $1 million has now gone up to 4.9%. What's the value at risk of that portfolio?
0 again.
0 again. So it'll become 5% when I give exactly 50 lottery tickets. At which point, my value at risk has suddenly jumped to $1 million. If I give all 1,000 of them, my value at risk continues to be $1,000. Now, the risk of these portfolios are different. You really are different. But would you say that they are, look at the value at risk distribution. 2 of these portfolios have value at risk of 0, and 2 of these portfolios have value at risk of $1 million. And they're clearly different portfolios. But value at risk is the same number to 2 of those portfolios, the same number to the other two portfolios and different numbers to all four. And the consequence of this, and this is what very, very important, value at risk is not a measure of risk. It was never designed to be a measure of risk. It was a measure of regulatory capital. This is what the central banks use to regulate their internal banks. And they chose this worst day loss in a month concept to regulate the amount of regulatory capital they have to collect from their member banks. Okay. This example that you have here is a very defined example. We're going to see later that, in fact, I mean, imagine you're a bank and you have 50 lottery tickets. And you say, damn it, I have one too many. If I have one less, then my value at risk drops. What can you do? Maybe what you do is you create a new bank and you give 20 lottery tickets to the new bank. Now, one bank has 30, one bank has 20, and both banks have a value at risk of 0. It looks like you're making risk disappear, but the only thing you're doing is you're making regulatory capital disappear. By the way, tricks like this is some of the things that some companies did just before the big crisis of 2008, because regulatory capital was the issue back then. But okay, let me just move over from that. So in the context that I just presented here, this methodology called the risk matrix methodology came up with the objective of calculating the value at risk of portfolios. And as I mentioned, this was so complicated that not only the methodologies for calculating value at risk were introduced, also methodologies for approximating value at risk or simplifying value at risk were also included. When it comes to the actual methodology, what can I tell you? I mean, I can say this is the algorithm, so I give you a portfolio and then you just write code to calculate that. That's not interesting. What I want to do, I mean, not interesting in a classroom, it's very interesting in the bank. If you have to do it, you don't have a choice. But what I want to do today is I want to walk you through some simplifications and some calculations we can do explicitly so we get a sense, a theoretical sense, a mental sense of what these risk measures are. And I want to start with the simplest assumption. The simplest assumption is that my investment portfolio has a normal distribution over time. Normal distributions are distributions that we can use to make calculations. So let me show you how that calculation would work. Now, before we do that, I want to pick your intuition to see what you have. And I have here an example of how value risk is done from a scenario generation perspective. In fact, this is how these things are actually regulated. The risk matrix methodology for most of its document does not does not do any assumptions about the probability distribution. What they do is they have a well-defined process to generate scenarios, which are things of what could happen tomorrow. That's what they do. Okay, so I have here 100 scenarios, and the scenarios that I have here are for not for stocks; they are for bonds. So I have 100 possible yield curves we can observe tomorrow. Doesn't matter; it's the same idea, right? Stocks, bonds, same idea. 100 scenarios of what could happen tomorrow. So with 100 scenarios of what can happen tomorrow, I can generate 100 values that my portfolio can have tomorrow. And here I'm giving you the value of the portfolio minus the value today, what's called the profit and loss function. So it's the value tomorrow minus the value today. So when it's positive are gains, and when it's negative, they are losses. And then from there, we can get the probability distribution and calculate the quantile. And so you know how to calculate quantiles because you know probabilities. But let me ask you a question without, I call this visual value at risk. Right? And I do that for instructional reasons. It's very, very useful. I don't know how wide, how big your display is. But even if it's small, you should be able to look at the second chart and tell me the value at risk from a visual perspective. Visually, what you think value at risk will be. I'm telling you, there's 100 scenarios there. So the number is 100. Can you attempt to tell me what the value at risk is from a visual perspective? We're not using calculations, we're not using computers, I'm using just your own human vision. Can you tell me?
Is it going to be like non-zero number?
Or as part of my question.
I think it will.
So this is how you do it, okay? Watch. I'm using my human vision. When I look at my human vision, what am I looking for? I'm looking for the 95th percent quantile of my loss function. Since I have 100 numbers, I'm looking for my fifth worst loss. So my worst loss is perhaps that. I don't know. And after that is clearly this one. And after that is probably that one. So that's probably my fifth worst loss. What number is that? It's about 5. So my value risk is 5. Do you understand that?
Oh, okay. Because, yeah, okay.
Yeah. I call this visual value of risk. If you understand this, we understand a lot. See, this is the same formula that I wrote earlier with the integral and this and that. It's the same. It's just that here we're doing this intuitively. Earlier we did it with some calculations. Understand?
Sure. So the value at risk is the biggest one-day loss, right?
It's the biggest one-day loss in a month, and this is a month of 20
month.
days. If you have 100 numbers, it's the 5th percentile. So this is the way to do a visual percentiles. And that's what I'm saying. That's what I'm talking about. If you have 100, the 95th percentile is the 5th worst loss. If I give you 1,000, it'll be the 50th worst loss. That's value at risk. This is what I need everybody to understand. Because you understand this, everything else is much easier. The rest is just formulas, but this is what you need to understand. So for those of you here, for those of you watching this video after class, this is the example I need you to understand. You understand this? Everything else becomes much easier. If you don't understand this, even if you are a master user of formulas, you don't understand what you're doing. By the way, this method that I'm having here is what's called Monte Carlo value at risk. And the trick is, how do I generate these scenarios? And I can use Monte Carlo methods for that. There will be once a lecture here where I talk about Monte Carlo methods. And now you know why. Because with Monte Carlo, I can generate these future scenarios. Oftentimes the regulators don't like me to use Monte Carlo. Most of the time they don't, because how do you know how these things are calculated? How can I defend to a judge that my Monte Carlo method was right? When you see Monte Carlo, when I explain Monte Carlo to you, you will see that it's impossible to defend that to a judge. If I use a machine that has been ratified by the regulators, like the radar detector, if I'm picking up speed from cars, then that's a different story. But then that's a machine which is done by a third party, which has been approved by the regulators. Oftentimes, what regulators would do is they would say, these generated scenarios are done in a very precise way, which is as follows. Look at all day changes, all 1 day changes since 5 years ago. If the year has 200 days, trading days, that's about 1,000. That's about 1,000 points. So look at those 1,000 points and take the 50th worst day, the 50th worst loss. That's value at risk 2. With the advantage is that everything I just said here, you can defend to a judge. You generate all the changes from 5 days ago. It's very clear what it means. You evaluate your portfolio, what your portfolio would have been worth if the changes between today and tomorrow would have been the changes from 3 years ago to 3 years minus 1 day ago. You look at that change of the portfolio, and that gives you this probability distribution. So these numbers will come from a recalculation of your portfolio and the very well specified market conditions. So this can be made into law, and you can defend this in front of a judge. Understand? You understand this, you understand risk management. Because now, everything you do in risk management is to just change the methodology, to change maybe the calculations, the assumptions, but the process is the same. You have very well-defined processes, very well-defined methodologies, and you just make them happen. Okay? All right, so let me go to a very simple situation. I call this the Gaussian value at risk. Let's say that my portfolio has Gaussian dependence. It's distributed like a normal distribution, and then if that's the case, then I don't have to generate scenarios because I know what the answer is going to be. If my portfolio has a Gaussian distribution, that means that the profit and loss is distributed like a Gaussian random variable with a certain mu and a certain standard deviation. So if I know what the mu and the standard deviation are, then I will know what that probability is. I don't have to generate scenarios, I know exactly what it is. So if I want to calculate the quantile of my profit and loss function, I can do that using the quantile of my Gaussian quantile function. I call it phi. So the profit and loss distribution function is phi of my level A, 95%, minus mu divided by C. And if I pick some well-known levels, like for example 165 like 95%, the quantile of 95% is 165. This is the quantile for the Gaussian. If I pick 99%, the quantile for 99% for the Gaussian is 2.33. That means that value at risk has an explicit formula because it is the volatility of my portfolio times 165 if I'm looking for the value at risk with 95% confidence interval. If I'm looking for 99% confidence interval, it will be the volatility times 2.33. So for example, 2 standard deviations is already a very good approximation to value at risk. It's a little bit more than 95% and a bit less than 99. So Gaussian value at risk boils down to the calculation of volatility. Now, we've been calculating volatilities for a long time already. So that means from a risk management perspective, we can do value at risk calculations in that context. So I have an example here. Maybe I don't know if let me ask you to do it. I'll give you 5 minutes. I shut up a little bit, and you and then you. I want you to gain confidence that you can do it. Okay, so this is I have the solution here. You can just, but I want you to convince yourself that you can do it. Okay, So can you do this yourself? This is perhaps your first value at risk calculation. You have now entered the world of So this is the daily value at risk calculation. Then you go from the daily to the annual by multiplying by the square root of 365. If I have 365 days, I don't want to get bogged down on the number of days in a year. And that's how you would do that. Now, let's take this concept now, which is, as you see, very powerful. Gaussian portfolios are lovely. We've already encountered them, how useful they were to calculate sub-ratios and this and that. Okay? So it's a nice proof of concept situation. It's not very practical, but it's very good for intuition development. Now let me talk about multivariate Gaussians, in particular Gaussian of dimension 2. The Gaussian dimension 2, you may have seen it looks like something like this, which actually I don't like this type of expressions very much. It is true that it avoids matrix notation, but it's just very complicated, the way that the volatility is and the correlation and all that enters this. But anyway, I'll just describe this to you. I'm about to get rid of it very quickly. In this formula, you may recognize there are the correlation between the two risk factors, the marginal means of each x and y, and the marginal standard deviations of both x and y. And if I like to write this in matricial form, where the covariance matrix is, well, the variance covariance matrix, and the mean vector is just the vector. And then the matricial form is going to have this expression. It's just the exponential of the matrix multiplication of the inverse of the covariance matrix times the precision vector minus the mean, normalized by the square root of the determinant of the matrix. So if I have portfolios now which are of higher dimensions, then I can, what can I do? What can I do is I'm going to borrow another expression we already saw, which is how portfolio volatility works when I have a collection of assets. And I remind you that when you have that, the volatility of a portfolio of assets. So if I have a portfolio of Gaussian assets, the result is also a Gaussian portfolio in dimension 1. So I can use my one-dimensional Gaussian calculation to get my value at risk. So if I have a portfolio of assets with a variance covariance matrix given by a certain V, then this is my standard deviation of my portfolio. In other words, the standard deviation of my portfolio is this one, or my portfolio, although it's higher dimensional, behaves like a one-dimensional portfolio with a standard deviation given by that. So I can use my one-dimensional value at risk calculation to determine that the value at risk in dimensions for a set of assets which are distributed like this with a variance covariance matrix given by sigma is a linear combination of these assets, and the value of my standard deviation, variance, actually the value of my variance is the matrix multiplication of my variance covariance matrix times the weight vector to the right and to the left, and that gives me a value at risk number for a multidimensional portfolio of Gaussian factors to be exactly the same as before. It's sigma times the Gaussian weight, but of course sigma now refers to the number that arises from the combination of my weights with the individual variance covariance entries in the matrix. Okay, so that's how this is done, and this is very easy. Again, I have another example, I'll explain, and then I also want you to convince yourself that you can do it, whether you're watching this live or on the video. Please stop the video here and then just do this on your own. If I have a portfolio with two assets, and one with 5 million to stock ABC like before, and one with 8 million to stock DEF like before, And if I give you the individual volatilities of 2.98% and 1.67%, and then tell you the correlation is 67%, then I ask you to calculate the 1 day. Sorry, I want you to calculate the 1 year value at risk with 95% confidence interval. Can you do that? I give you another 5 minutes.
I'm sorry. This is for 1 day, right?
What I want you to do is this. I have the 1 day volatility for stock A, the 1 day volatility for stock DEF, correlation of 67%, and I want you to give me either the 1 day value at risk or the 1 year value at risk. I don't care, because one is the multiplication of the square root of 365 times the other. Give me the value at risk with 95%. Give me the value at risk with 95% confidence interval. That's all I'm saying. Okay, I'll give you 5 minutes. The reason I ask is I want you to gain confidence in these things. By listening to me talk about this, you may get a false sense of security but I want you to actually, and then you get a real sense of security, because this is very, very easy, but you have to do it yourself. That's 1 day VAR, and that's the annual VAR.
Yep, that's what I got.
Good. All right. So you have a black belt now in value at risk calculations. It's not hard. It's really not hard. But now that we've climbed this hill, I'm going to make some comments. The first comment is about a practice called risk budgeting. And this is based on a very mysterious formula that I want to bring to your attention. This gives us a way of thinking about risk in a very mysterious way. We've seen this expression for the volatility of a portfolio many times now. The volatility of a portfolio is the square root of the matrix multiplication of the variance covariance matrix times the weight vector to the right and to the left. And if you do this, this is a very simple check. You can do this yourselves. If you take the derivative, the partial derivative of the volatility to the weights of the portfolio, multiply by the weights and add over all the weights, you get the volatility again. Okay, it's a very nice textbook calculation. I can ask you to do it, and then you just do the derivatives and you see that it actually holds. But look at the interesting expression this gives me. This gives me a very interesting expression where it says that the volatility is the weighted average, weighted by the allocation to that asset of these numbers, which are called the marginal risk contribution or the ith asset. So we build on an exact mathematical formula to create a new risk-related concept, which is a decomposition, a linear decomposition of a nonlinear object, the standard deviation, that helps us understand from a morphological perspective, mathematical morphology, just the way the equation looks like, how risk can be decomposed into its forms with the allocation acting on new objects that we define marginal risk contributions. This is used very much in asset management, not so much in banking. Because in asset management, this creates investment policies. This is what asset managers sometimes do when they want to allocate risks to different parts of their investment portfolio. This is the way to do that. So I just mentioned that it is not related to risk management so much, but it's just related to the concept that we saw. Now, the next thing I want to discuss is how value at risk has been criticized by some academics, and the criticism is valid. It's still, we know that it's not a measure of risk, it's a measure of regulatory capital. We discussed that already. But one of the criticisms that has been given is that if I take a portfolio, I can break up my portfolio in such a way that each of the portfolios has its own different value at risk, but the original VAR has no relationship to these two VARs. These two VARs could be smaller, bigger, the sum could be smaller, bigger, nothing. We already saw that when we took my portfolio of 50 lottery tickets and I broke it up into two. Then a value at risk of $1 million dissolves into a value at risk of nothing plus nothing. And this can happen at the institutional level. We can have the value at risk disappear with that. Value at risk is not sub-additive or super additive or anything like that. And because of that, some people have gone on to define what they call coherent risk measures. You may have a course in this program that may address that, not in my lecture. And there is a relative of value at risk, which is called conditional value at risk, that does not have that consequence or that nasty a characteristic. The value at risk, when you break up the portfolio, always goes up. It never goes down. Okay? And this is the definition of it. It replaces the probability of exceeding by the weighted probability of exceeding. In other words, it's a truncated first moment. It is not just the probability of doing something. I'm not interested that we spend too much time on this. I do want to mention it so that you know. And it's a relative of value at risk. And in this context, what I'm going to now do is dig a little bit deeper into the risk matrix calculation, actually the risk matrix methodology, all of it, and tell you how we can think about these risks in a different way. By the way, I know I've been lecturing for a long time. I did not take a break. I think I will be able to finish in about 15 minutes, so we can just, instead of a break, we can take an earlier end time for the lecture, okay? And then I let you off to enjoy your Saturday.
Sure, thank you.
Okay, so let me look at the value of my portfolio called P, as a function of my risk factors. The risk factor could be a number, it could be a vector, we don't care. P of R is the value of my portfolio as a function of the risk factor, whether it's my yield curve, whether it's the value of my stocks, whatever it is. So PR, the value of my portfolio in the future, tomorrow, next month, will be the value today plus the partial derivative of my portfolio valuation with respect to the risk factor multiplied by whatever my risk factors will change between today and tomorrow. So this is something that you have already seen. This is Taylor's theorem, the expansion of a function using its derivative. It's the first order Taylor approximation. You've seen that. And what we have seen is that if my portfolio, if my risk factors are Gaussian, if this is a number, it's no problem, it's all great. If these are vectors, then this is going to be a dot product, this will be a matrix, or sorry, this will be a vector, and it will be also a vector. And then what I have is a sum of means and the dot product or the matrix multiplication of various covariant matrices times weight factors. Either way, these are things that I can calculate, these things that I know. And if my risk factors are Gaussian, then the PNL will be Gaussian. And if the PNL is Gaussian, then I know how to calculate the value of risk. So the exercise you already did is actually very uniform, it works everywhere. And this is what risk matrix was proposing. Now, let me see what happens if I take this expression and I include the second order terms. In other words, I increase the accuracy of my approximation. So this works for any portfolio as long as my risk factors are Gaussian. My portfolio does not need to be linear. I approximate this with a linear. Now, of course, if my portfolio contains some quadratic terms, what I have here, this is not Gaussian anymore. This is not Gaussian because this term is not Gaussian. The square of a Gaussian random variable is not Gaussian. And then a lot of the niceness that we have with our Gaussian value at risk calculation somehow disappears. I remind you of one thing, which is going to be important in another lecture, is that these portfolio properties, the value of the derivative of my pricing function with respect to the risk factors are very, very important. They are called portfolio sensitivities. And I'm going to spend time. I will have a separate lecture addressing them and how useful they can be. Okay. For today, I'm just going to include them in this formula. Risk matrix uses them in their formula, the one created by JP Morgan. And when I have that, that's the value of my portfolio. That's the risk factor I have. Could be a vector or a number. It doesn't matter. But tomorrow, I know the value today. I do not know the value tomorrow. The value tomorrow is approximated by looking at the value today and then how this approximation will make these things change, using the portfolio sensitivities as my guiding factor to understand how that changes. Now, one of the main applications of this is to bond duration, because when I have a bond portfolio, this is the formula of the valuation. So this is the P that I have here. The delta is something I can calculate explicitly, so this is a number that can go there, right? And I have a second derivative. The second derivative can go there, and this is something I can calculate. I don't have it in my slide, but I can do that. So you see, these are expressions that I can use to approximate values at risk. Now, the regulator will not allow me to use an approximation, but these approximations are useful for me to understand mathematically the objects I'm working with. Okay, and I want to present this to you to highlight another important property, which is that the portfolio sensitivities can help me solve a very difficult problem, which is to understand how my portfolio value will change by looking at the things that I observe today, because this is something I observe today. I have no doubt about this. I know what this is. I observe this today. I have no doubt about what that is. And I observe this today. I have no doubt what this is. So the things that I have doubt that I will have in blue, this I don't know. I don't know my risk factor tomorrow. I don't know my risk factor tomorrow either. I don't know my risk factor tomorrow either. I don't know this difference. These are the things that I don't know. So in red is what I know and in blue is what I don't know. Can I use some approximation, some way of thinking about the probability, maximizing the use of what I know and minimizing the use of what I don't know? And that is this approach that is called the delta normal VAR, which is what credit matrix did. Now, at this point, we just opened another interesting Pandora box, which is, I'm going to leave here because this is something that I want to address in its full glory in another lecture when you're well rested. This is very complicated and it's going to be something very important for us to attend, which is the significance that we can extract from this partial derivative. They're going to be partial derivatives. If we're going to be looking at small portfolio changes, like for example, from one day to tomorrow, from one day to the next. Because markets change not very much in a given day, then there is hope that the Taylor approximation will help me understand the changes of my portfolio between today and tomorrow, maximizing the use of what I know, which are going to be the partial derivatives of that. So I expect this to be the topic of my conversation, of my lecture tomorrow, and I will end with a very important practical exercise, which is we're going to be able to calculate from a sensitivity perspective. We're going to be able to calculate what happened, or at least to do a forecast that Silicon Valley Bank was in trouble when rates started to go up. You may know Silicon Valley Bank is a bank that went bankrupt a couple of years ago. maybe 3 years ago, a couple of years ago. And that was a result of the very high increase of interest rates in the market. Okay. From a sensitivity perspective, we're going to be able to include some calculations that, of course, they're approximations, but the result is so large that we're going to be able to draw some very important conclusions from those calculations.